Good morning. This is Walter Morello, and this is the 100 Millionaire Podcast. I'm here with my amazing co-host, partner, friend.
Hey.
What's your name? Mike Schein.
That would be Mike Schein. Morning,
Love it. Mike, what is your slogan? What do you love to say? What are you here for?
Massive income from passive income.
I love it. Today we've got our guest, David Laborde. David, how are you feeling this morning?
Yeah, feeling great. Very positive vibes. I actually, before this podcast, I went and watched a lot of your previous podcast, and I really enjoy the energy. You guys have a really positive vibe, and excited to be here. So
great.
Excellent.
Welcome.
Excellent. So
welcome.
That's one of the reasons Mike brought you on, because he likes you. So like attracts like. People who have the similar energy are gonna want to hang out and spend time together. So welcome, sure. David. Tell us a little bit about your business and what you do.
Yeah, I work in the private lending, hard money space. Been doing it for, personally, I've been doing private lending for about 5 years. As a full-time business, I've been doing it for about 3 years. So we're just ramping up right now. We currently have anywhere from 13 to 15 million under management at any time. Things buying and selling off and, things of that nature. So, yeah, that's kind of where we're at. Our whole goal for the Rhode Island market is to, take what was previously kind of a mom and pop situation. You had a lot of folks who were, private lending on their own balance sheet. You had folks who were pulling together $100,000 each, so you get $500,000 together and you put it on the street, and that's great. You get a little bit of return. And that's exactly what I was doing.
What's that like?
Yeah.
Taking your own private money and lending it. Sweet.
Nope. That's money, man. That's how it's done.
Yeah, and you've got these great collateralized deals, and there's nothing wrong. I mean, that's exactly what myself and a previous partner of mine, we were working in another business. We can talk about that a little bit. And we just were putting our own money out on the street. I said, what if we went out and sought out some institutional interest in this mom and pop market and, just centralized it, took it from a decentralized network where, every attorney like Mike has, they probably have a 3 or 4 page sheet of lenders, to hand out to their clients and say, because folks just run out of money. It doesn't matter if you have 500,000, a million, 5 million, sooner or later when you're lending, you're just going to run out. So you got to go out there and find institutional interest and bring it into a market, and that's kind of how you scale a business up.
So but Dave, you were telling me beforehand, you kind of have an interesting story between you and your partner, because you come from sort of different backgrounds that led you to this Fox Point lending.
Yeah, we just happen to be lending in real estate. So we don't come from a real estate background. My partner spent years working at Moody's rating agency. She's a super accomplished gal. But yeah, she comes from a private equity background, and I actually come from an underwriting sales background, which is kind of interesting. But and I want to say real quick, I really admire what you guys do, because my personality is first and foremost, I'm an introvert. And the fact that you guys get on here, you're putting yourselves out there, and you're connecting with people and building a community. I really admire that, because my knee-jerk reaction is to close my door and just underwrite,
So that's so funny. I said that to Walter. I said, Dave told me he's an over-preparer. And we talk about in this podcast a lot the disc profile. Yep. And I said, so we're like high eyes, which influencers, we like to go out and talk and have a lot of fun.
Yeah.
But you're more of a C, more calculating. And so it's kind of, it makes sense that you would want to close down and not do this. But I mean, I love this stuff, but the stuff you do, I would probably not want to do.
Yeah, it's a lot of, I call it high-level ditch digging. It's a lot of repetitive, doing the same thing and taking those systems, building out systems and just kind of sharpening them, getting them as sharp as possible.
Such a need for what you do, though. It's just.
Oh yeah, thank God you do it.
Because when you came to the RIA meeting and you talked, you know, there were a lot of great people who come visit, but I was like, holy crap, I have to go talk to that guy right away. And I heard at least, no exaggeration, at least 10 people around me say the exact same thing. So you must have been mauled up at the front. Yeah.
Yeah. Yeah. How do we take all of our individual talents and build teams and help each other grow, you know? And I just liked a lot of what you're, I was looking at your Facebook page, Galter, and I just like a lot of the things that you're putting out there in regards to, you know, getting ahead by pushing somebody else down is counterproductive, you know, and all of us going out and specializing and getting really good at a certain thing. And then, you know, grouping together with other folks who are really good at what they do is the best way to grow together. You know, high tides raise all the ships, you know.
You got it, Dave. It's all about raising the high, creating our own tide and raising everybody up with us.
Yeah. You might be categorized as a C, but you're crushing it right now. I don't know.
Oh, good. Oh,
yeah,
thanks.
you're doing a great job.
Yeah.
Awesome.
Yeah. I actually have a bit of an odd story of how I got here. My first job, which actually relates more to what I do now, I spent the first 18 months of my career in a small dark room working for a company that bought and packaged up and what's called securitized. I'm sure everybody's heard that buzzword, securitizations, things like that, which is just another way to raise money at a high level. But basically, I was working in a small dark room where there was these big teams of originators. The group I worked with probably had about 450, 500 employees. And these guys would just go out there and originate. They would just all day. They were just focused on that all day, every day on the phones, originating. And then they would send us all their crap. And they would send us all these, you know, they'd send us cell phone tower lease deals. They'd send us structured settlement deals, lottery receivable deals, everything you could possibly think of. They'd send it to us. And I'll never forget on the wall in this room. And you have to remember that this group was doing 300 million a quarter. You know, they're bundling this stuff up. So just the quantity was just insane. But on the wall, I'll give you the PG version of this, but there was a sign that said, "Find it, sign it, F it." And basically,
how's that for a mission statement?
Yeah.
how's that for a mission statement? Yeah. So basically, we were doing all the grunt work. We were doing all the grunt work for the guys who were out there, you know, on the front lines. And it led to some really good, you know, water cooler moments where we'd say like, well, we have all the value because we clean up all your crap. And they'd say, well, there'd be no crap to clean up if we weren't out there finding it, you know?
Yep.
So that was a lot of fun. And very quickly, I realized that the guys who were making all the money were the originators. And
it's
so
not a fair world.
Yeah.
Right.
Yeah, apparently the guys who bring the money in is more important than the guys who count it, you know.
Right, right.
Like me bitching about all the realtors making all the money and didn't close the deal.
They're finding the clients, right? We're out there on the grind.
Exactly. It's relative value.
I switched over and, you know, I switched over and within 2 years I was in a senior sales position. And I actually went on a run one time. They immediately put me on the road. I was traveling probably 80, 85 times a year all over the country. And I remember I went on a run one time, 45 deals in a row. I never lost one. 45 in a row.
What were you selling? What was this, the lottery winnings? Which one was this?
Lottery structured. Yeah. All kinds of meetings. You know, it got to the point where they'd send me to meet with people where they knew there was no deal, just to like, you know, just to screw with me. And you know, I'd say to myself, you know what? Okay, that's fine. I'm gonna come in here. I'm gonna figure out like how to structure a deal. So
prepare. I bet you over prepared, didn't you,
Yeah,
Dave?
right.
Unbelievable. Yeah, unbelievable. And you know, I in the beginning I probably came at people too strong because I was over prepared, but so I had to learn how to like back it off. And you know, I'd stay in people's houses for 10 hours. You know,
Yeah, so
I'd
these
order
are like
dinner. You know,
these are like structured settlements. So you're somebody's got some money and you'll pay them like a one time to take it over from them, kind of like.
Yeah. I guess the most, without getting into the weeds, the most simple way to think about it is discount rate brokerage, you know? So, you know, you've got folks who have guaranteed payments for 10, 15 years. And, you know, you go and lock in a rate with a provider at 6, and then, you know, you lock in a rate with them at an 8, and it's kind of like a paper shuffle.
Gotcha.
Yep.
What's, I see commercials on TV for like J.G. Wentworth. Is that?
Yeah, they're an aggregator. It's funny enough, there's a hedge fund, I won't mention their name, but they have gone out and aggregated the entire market. So all these people who you see out there advertising, they're probably owned by the same
one company.
Yeah.
Yeah.
Smart.
Yeah.
I love it. So Dave, you're definitely I'd say a bean counter, right? In the beginning of life, you're a bean counter, and then you started recognizing the value in sales. They sent you on the worst appointments, and now how did you get to raising private capital? How did you get to doing this personally yourself and why a partner? You know, if you're able to do, it seems like you're able to do both sides of the business. Why bring a partner in? And so a couple of questions there. I apologize. And if there's a structure to the way you're going through this, feel free to continue through with that. But I want to make sure we hit those points.
Yeah, that's a good question. You know, I've developed a philosophy, and it's something I really live by, but development over dollars. I really believe that, you know, if you actively pursue developing yourself in whatever career, you know, in a very fine-tuned way, like for instance, if you're interested in real estate, if you're interested in, you know, bean counting or sales, you know, focus on all the steps it takes to be the best version of that skill set, and the score will take care of itself, you know.
That's awesome. That's you're right here. You know, the 100 Million Years podcast, the first 5 episodes focused on the 5 foundational books, and it's all about that. It's development over dollars. That's really where we're coming from. That's so awesome.
Good
yeah,
job.
and alliteration, development over dollars, and
Right.
saying things that stick in people's brain. But
Massive income from passive income.
yeah, exactly.
I love it.
Exactly. So, you know, so I'm just kind of on a mission, you know, I'm on this mission to just keep my focus on development. And, you know, in that way, I think you kind of, in Galter, I've heard you talk about this on several of the different podcasts. You're changing the relationship from chasing dollars to dollars chasing you, right?
Yeah.
And if you can kind of visualize literally chasing after money versus, you know, money kind of chasing you, that is the effect of switching your focus from dollars to switching your focus to development, you know?
Yeah.
And
me and Mike Schein talk about that exactly all the time. How do we turn the relationship around and just attract instead of hunt? Dave, you're on track, man. You're clearly doing it in your business.
yeah, exactly. So just to kind of bring it full circle and to answer your question, you know, that's something I really learned being on the road and meeting with so many people all across the country: Texas, California, Illinois, Colorado, almost every single state in the United States. I learned that folks who have windfalls, you know, think lotteries, think inheritance, things like that. They receive the money, but then have a very difficult time holding on to it. And by focusing on development, what happens is that the money will happen as a byproduct. And by the time you have it, you'll have the skill set to actually keep it, you know, and to grow that wealth. So,
if you receive $1 million, you better become a millionaire quick, because if you don't, it's going to disappear on you.
And vice versa. Walter, you're always talking about the fact that even if you started with 0 tomorrow, you'd be back up right away because it's the skill sets. Yeah.
Sure. Yeah. They can never take that away from you. And I just love the little info you had on your Facebook page in regards to money versus books. You know, you know, it's the same paper. You know, paper's paper. But one of them is going to disappear, and the other one will be with you for the rest of your life. You know, so. But anyway, in regards to partnering, you know, we have to partner, right? You know, can you go out and source money? Sure, but it's the cost of time.
Yeah.
Cost of time. And it's not worth me going out and building new private equity partners when I can partner with somebody who already has a rich network of private equity, and I have a rich network of originations and underwriting. So when you pull those two things together, you have a dynamic team who can then go and scale a business. So that's why you partner.
Yeah, so we have people, hopefully lots of people listening to this. If you can rewind, that was like podcast gold, because time is the only thing you can't get more of, no matter who you are. And Dave just told you a way to get more time, actually, because he's
we're all
going out and sourcing, so you're not wasting your time. It's if you can have more value in doing the thing that you do best and leave Dave to go get the money, that's brilliant. So don't miss that point.
Right.
Yeah.
And make sure people aren't getting hurt, because sometimes people go out and raise private capital and they do it the wrong way. Not putting a mortgage on. There's a lot of different things that young private money, and we all did it. I've done it. Everybody I'm sure who's raised private capital has just not protected the investor. And now having somebody who's doing that and protecting the investors, it's important. To follow all the rules and dot the I's and cross the T's.
Yeah.
So
It's not a game for fools. I'll tell you that. There's a lot of ways to get hurt in every imaginable way. So it's a good point.
Attorney, I've seen that. That blew me away when I started seeing some of these young investors. No mortgage, no note, nothing. Just, oh my God.
Yeah.
Okay.
So Dave, so that's how you picked up a partner, and very simple. You just decided, hey, I need somebody who is good at going and grabbing the money, right? Going and raising the capital. They got the network. How did you meet your partner, and what does the relationship look like today? I assume she grabs the money and you just underwrite.
Yeah, it's kind of become an amalgamation of the two, right? We go to investor meetings together, so we talk every week. So her contacts have become my contacts. My originations network has been hers. So, these partnerships become marriages. So everything, all of the intellectual property and everything, and that's actually why non-competes are so important. I should mention is because, you're really sharing all of the things that you've spent your entire career building with that other person, and vice versa. And in regards to protecting yourself, non-competes are a really good way to make sure that that person doesn't just go out and if you're dealing with a bad actor, usually you don't know that until after the fact. So having those non-competes is a great way, especially at a high level, to make sure that you don't lose out on potentially a ton of upside in businesses. But yeah, so it's just become an amalgamation of us together working on sourcing money and things like that.
So you're lending money personally at some point, and was there just a moment where you said, well, if I can lend X amount of dollars, if I can find some investors out there, I can lend 10X? And
yeah, actually you start and that's where it gets really interesting, where a lot of people don't like the going through the machinations of underwriting, because it's so monotonous. There's just so much, but when you do, you start to see patterns evolve, and the patterns that you see are that the difference between, you start seeing these products like a box. You see a mortgage box, a structured settlement box, a lottery box. I think the funniest one, kind of the nichiest business I've ever seen, is the cell phone tower lease box, right? That's an unbelievable business, by the way.
Yeah.
Buying and selling those is crazy. There's a whole market for that. But you start to see that these boxes look very similar, and then you start to compare them. You say, okay, I could spend, 1 week underwriting this box and the yield is this, or I can spend 1 week doing this and it's similar. So I started looking at and I kind of skipped over leaving the company I was at and working for myself and things like that. But you start looking at those two boxes and you're saying, okay, this particular product has a cap and this one I can scale.
Right.
And so for me, I was sitting at my real estate attorney's office, and he was showing me a list of all the private lenders that he had here in Rhode Island. And it was 4 pages long,
Wow.
you know, and it was local groups who were just pooling their resources together. So anytime he had somebody who was looking for private financing, he'd just have to go through the process of calling down the list.
Right.
And so, you know, it's like a bell went off in my head, and I said, you know, the business I'm working right now is capped, whereas the lending real estate business, you know, is almost infinitely scalable. You know, you can write as much business as you like, and the underwriting for each, actually for real estate, I always kind of say this jokingly, but you know, the structured receivable world is like a colonoscopy, and real estate is like a physical, you know, compared to the underwriting. So, you know,
breathe.
Yeah, bend over and cough, right?
Good.
So
Yeah.
so so it was just a no-brainer to well, I shouldn't say a no-brainer because I had to kind of transition my entire life, but I sold my structured business and then transitioned to the lending business, and we're scaling it now.
So that's an interesting topic. I want to get into that just for a second. So you built a business. How long did it take you to build? How long were you in it? And then you sold the business.
Right.
How long did it take you to find a buyer for it? How did you market the business itself?
Yeah, actually, so I left the company I was working for. I left on really amicable terms. Actually, I left the company that I had previously spent my entire career at, started my own company. And this is actually a little bit of an interesting story. And I think it's important for people to know, you know, enemies are expensive, you know, so if there's any way to build a bridge, you know, even if it costs you a little bit more, it's infinitesimally more profitable to build that bridge. And when I left the company I was working for, I flew out to their corporate office and I said, hey, I'm going to leave. I'm breaking up with you. Right. And they're like, okay, we don't care. You're so small. But I said, but listen, here's the difference. Everybody else just leaves and they say, sue me, or they fight with you. I said, I don't want to fight with you. You know, I have a 2-year non-compete. Like, let's make a deal. And they said, okay, here's the deal. For the first year of your business, give us 50% of your revenue, but we'll fund all of your business. And we're the biggest in the industry.
Oh, wow.
Nice.
Amazing.
And in that first year, they gave us premium rates, you know, so even though we paid them an ungodly amount of money, they gave us premium rates and we funded all our business. And I'm actually still friends with those guys today. You know, I'm still friends with them today. And we ended up doing a ton of business together over the years.
Do you still do business with them? Do you still use their money? Or?
No, because they work in a different, they work in the structured world. So I still have old clients who will call me, you know, maybe twice a year. I'll have, you know, just as an outlet, I'll sell them something. But yeah, if you called them up and asked them an opinion about David Laborde, they'd say he's a great guy, you know, and so it's great. You know, it's great. And it's really important, even when you're breaking up with people, to break up in the right way.
Yeah, smart. Don't burn bridges. People always
I love that, Dave. That's great advice.
Don't burn bridges, but it's not, that's a great story.
Yeah. So anyway, when building a business, I believe I heard Tony Robbins say this, always run your business like you're preparing to sell it.
Yep.
And again, talking about parity, the difference between a piece of real estate and a business they're very similar, you know, in regards to the fact that you're still calculating a cap rate. You know, you've got the money the company is making, you know, you got your expenses, and then you're going to divide that by some multiple. You know, with real estate, a good cap rate is 4 to 10%. With a business that's, you know, maybe a little bit niche, you're going to have to go 20 or 30%, you know, which creates a lower, you know, valuation. So, so that's what I did. I built the business up to a certain level, and then I sold it at a 40 cap, you know, just for a quick sale.
Nice.
I sold it at a 40 cap, you know, because it's a niche business. There's a high learning curve, and I sold all my data, everything. and just cashed out, and then, found a new partner, and then started this business up again.
That's nice. And I think restaurants are around the same cap anyway. I think restaurants are around the 35 to 40% cap. So, because it is niche, it's tough to build up the clientele. But to be able to evaluate your business at that level and make a transition you were going to do anyway, that's pretty powerful.
Right.
Great job, man. Hats off to you, Dave.
Yeah, thanks.
And your partner, you said she worked at Moody's. So why was she an attractive partner to you? Like, what was the thought there?
Yeah, actually, I met her through. Well, I guess I should run it back. I had never sold a business, so I started researching business brokers.
Yep.
And just about the time that I kind of interviewed 3 of them, I realized that like I could do this better, in like in a completely like I don't mean that in any type of egotistical way. I just thought that I could better market my company. So
you knew it better. Yeah.
I knew it better. I felt like I could just kind of get in there and, potential, buyers. I felt like that first conversation is so important,
Yep.
So I guess it just came down to trust. I just had to trust.
Sorry to interrupt, but that just reminds me of my dad. My dad's bought and sold a lot of real estate, and he would say to the realtor, "Listen, you're going to get your commission, but stay out of the way. I'm going to go talk to the buyer, and you'll get your commission, but I know my building." Yeah. So,
Bingo.
Yeah.
Bingo.
That's funny.
Walter, you're a broker. I mean, it's life on a wire. I mean, that's what it really is when you're running your own business. And so as a broker, you really have to add value to the transaction every single time, Yeah.
And for me, I'm a salesperson. I've been very clear about this. I'm very clever about structuring. I stay as a leader of the team, right? So I have a team under me, but I always have a broker over me because a broker is they prepare the documents. They make sure everything came through right. They're legal side, right? If you could say they're the back end, right? They protect you, right? So, but we're the front end. We're sales. So instead of being a broker, putting myself in a position I wouldn't be fit for, I've always found a partner who is better at that side, and I stay on the sales side, leading a team like a broker. But at the end of the day, it's just what you're talking about. You have a partner who's better at that piece than you, and you stay doing what you're good at, and it's better to pay them. I love paying my broker, right? Love
better
it.
to pay them. Yeah.
Yep.
Yeah. The old adage, right? Penny wise and dollar poor. A lot of people will, lose $100 making 10. So let your painters paint. Let the guys who are skilled at what they're going to do. And Mike, this is my favorite. I don't want to do too many of these like old sayings, but this is actually one of my favorite.
We love this. We love
this is one of my.
It'll be on Walter's board behind him.
I'll be tweeting this later.
This is just stuck in my head over the years, but somebody said to me one time, you can actually file your own divorce. You can.
That's awesome.
As an individual, you can just go, you can fill out all the paperwork, you can come up the learning curve, but why do you pay a professional? Right?
Yeah.
It's a learning curve. Just pay them.
Exactly. Yep.
I have this discussion with my wife, not about the divorce. No, but there was in The One Thing by Gary Keller about you could probably clean your house better than someone you're going to hire, but your time is worth so much more. So just hire someone to clean the house and then go do what you're supposed to do.
Yeah.
Yeah.
I don't know how a laundry machine works. I've always dropped it off. I haven't touched a lawnmower in like 4 or 5 years.
Yes, single guy. Yes, single guy.
My grass is always cut. I never even see my landscaper. So.
Yeah, you said that.
You're very well dressed.
That. Yeah.
Thank you, sir.
Brenda was mowing the lawn of one of our properties, and Walter's like, I haven't mowed a lawn in 4 years.
Yeah. And I got a lot of lawns. There's a lot out there.
Right. They grow grass in Fall River.
Yeah.
We grow grass in Fall River. Yeah, Massachusetts grass is the same as Rhode Island's grass. We just get taxed.
So I interrupted you before. You talk about your partner and why she was a good partner for you.
Oh, yeah. Actually, I met her through, so I marketed my business through Biz Buy Sell.
Yep.
And
I always used to look at those listings. I love
Yeah.
that.
So
Me too.
yeah.
Gas,
So just
gas station in Florida, you know.
yeah,
Yep.
gas station in Florida. So I, you know, without having a lot of, I'd never sold a business, so without having a lot of background, you know, it just seemed like a good outlet. You know, I said, let me try this first, and so I got a lot of interest from. Actually, people were just looking for my data because I had about 6,000 clients. I'd been paying, you know, over the course of my uh, the life of the business, I'd been paying a data company to, you know, do all the background and search the databases and find all these people. So, yeah, I got a lot of interest from insurance companies and people who were just looking for an add-on, you know, to their business, you know, looking to plug my business into what they're already doing, you
An
know.
existing business. Yep.
Yeah, you know, companies would say, all right, we have a sales staff of 300 people. You know, we're working in the financial services business, you know, we're financial sales business.
Yep.
You know, and so a lot of times it's easier than reinventing the wheel to just go out and find people who have their own systems built. And so what they were buying is my standard operating procedures manuals. They were buying, you know, my database procedures. So they're basically just looking to take that and plug it into, you know, what they're doing. But through the course of doing that, I met my partner because she was looking for a company to buy.
Right.
And so I didn't end up selling her this business, but, you know, through the process of meeting her, she just kind of, you know, we got to know each other. She lives in Manhattan. And so she, you know, she said, all right, well, what are you up to? I guess after we met each other, she said, well, what are you up to next? You know, maybe there's something we can collaborate on. And through the course of doing that, that's how we got involved together. So
Wow, that is impressive. That is impressive because clearly you've built something. You've built something so based on systems that you could sell it, and she was attracted to that. She saw that you've been able to build something, sell something, and I said, you know what? I clearly didn't have that skill, but seeing that skill in you, she said, yep, this is the person I want to work with. So Dave, what is it you guys do? What is it that who is your client? Who are you looking for right now in your business?
Yeah, that question 60 days ago is probably very different than the question now, but
All right.
For sure.
We have found it more profitable and you know, a better use of our time to focus on residential non-owner occupied lending. So that's 1 to 4 family, that's 5+ units, and, you know, mixed use, but where, you know, the 2/3 of the property is residential versus commercial spaces. So, you know, I say that to differentiate between commercial lending and commercial lending. Where
way to go, Dave.
Where,
you mean commercial residential and not commercial.
You need a commercial loan, not a commercial.
Yeah. We don't want to get into 6 to 9 month deals, you know, environmental things like that. We try to stay away from that as much as possible. Over the course of 3 years, we've actually only done 2 loans, you know, on factories, just because it's, you know, like, you know, it's too much, you know, it's too much to go through the process of, and we're not set up for it, you know, for guys who that's all they do. Then you build up your pipeline, you have a backlog. I mean, this is sales 101, right? So, you know, if you know there's a 6 to 9 month backlog on deals, then, you know, you have to build a pipeline, and then loans are just closing after that 9 months. But with residential, it's a quicker turnaround time. Once we have full packages, we can get stuff done in 72 to, you know, 120 hours. So for us, we're just focused on volume and things that we can underwrite really quickly, get people yes or no, and get them into that property. And there's a you know, after the properties are done, there's a back end market where they can then unload that property and we can get money back. So, so that's what we're focused on: commercial, residential.
And what's the typical term on your loans? Is it like a 1-year balloon note, or are you doing something different? What's
You know, we used to do 12 and 6, you know, 12 with an option to extend, but actually 12 months happens really quickly, and it was creating a servicing problem where people were coming to the end of their loans, and then now we have to deal with it. So even though it, you know, just from a business perspective, it was more profitable to collect the 2 points for the extension, we actually just write 24-month loans, no extension points, no nothing. Because of that, because of the cost of time, it's not worth it.
interest only or interest in principal?
Interest only. Yeah. Interest only.
You
And
have
we have a 30-year product. We'll get into that in a little bit, but
okay.
Nice.
And do they pay monthly, or you just have them pay it all back at the end of the loan?
that's an interesting model, actually. I have a friend in New Jersey who does back end loans where they pay. So he does 3 months up front. He has people escrow 50% of construction. I guess there's an almost infinite amount of ways to cut up the, way to market a loan. But for us, we just try to keep things as like vanilla as possible.
Yep.
We're going to collect 1 month up front. It's interest only, pay every month. And that's it. 24-month loans, 100% construction. Call us for, the rehab money as soon as as soon as a portion's done, things like that. So
Look, you've got a great product and you found a nice, easy way to package it that doesn't create extra servicing in the end. And I've been one of those offenders, right? Had a 1-year loan and said, you know what, let's hang on to this a little bit longer because we put tenants in the building. So we were able to, we could hold that longer. We could really extend those notes. And it didn't make sense for us to refinance because we knew we were going to sell it, but we wanted to get past that year, to avoid the capital gain. Well, jump into capital gains as opposed to getting hit with income tax. So there's a place for that where, especially with multifamilies, where it's like, yeah, I don't mind paying the 12%, just extend out a little bit longer. Like that's perfectly fine.
Yeah. I'm trying to keep the phone calls coming into the office origination calls as opposed to servicing calls, and as in an effort to do that, we've just extended everything to 24 months, and that could change, right? I mean, as our team grows, as we get larger, it may become a thing where we can take on the extra headache of going back to 12 and 6 or 12 and 12 or something like that, which is, as a company, is a little bit more profitable. But for now, congratulations to our future clients.
You get 24 months.
You get longer terms at a lower rate, effective overall.
So I've mentioned on the show that I loan money through my self-directed IRA. It's obviously a very small amount, but originally I was doing 1-year balloon notes and people were paying monthly, but I've recently come in contact with some what I would call more sophisticated borrowers, and they're always like, well, do you really have to have me pay you every month? Just when the loan is done, I'll pay the whole thing. And from my point of view, it's like I'm not always looking for that check every month. As long as I, have it secured with a mortgage and I trust the people, I'm good with that. So there's not the monthly, the process of taking in the money and making sure it gets to where it's supposed to go.
Sure. And Mike, just to add, some validity to what you're saying, I know a group that's doing like 100 million a year, and they do all their loans the same way.
I'm on the right track. Is that you, Walter? We're gonna get there.
I'm following you guys. I see it. I love it.
I'll put it on my vision board.
Mike, I will let you know. The next check won't be in the mail. We're just gonna hold it for the end.
We're one of those sophisticated borrowers.
Yeah.
Thank you, brother. No, I like paying monthly. I'm gonna keep it going, but that, Mike, maybe the next one.
Cool.
So
what kind of what's the number for like lending? Like, do you have people who borrow like $1 million from you, or are they mostly like smaller loans? What's the?
No. Yeah, that's a great question. I like a nice padded portfolio. And again, it's because I really don't mind. I've got a good team here, and I really don't mind the underwriting. So, if you have one loan, at $1 million or 5 loans at 200,000, there's a lot more work for the second, but there's a lot less risk for the second, and so it's worth it to me. The extra work is worth it to me to write a lot of smaller deals. So our average loan size is 226,000.
Perfect. Wow, the actual.
I looked that up for the call. Actually, I figured that'd be.
I love that. You are an over-preparer, Dave, and we appreciate it because we love those details. 226.
Is it all first position, or is there any that you take second position on?
No, we don't do any second position. It's all first. First position. Our loan to value is 73%, and our loan to after repair value is 62% for our whole portfolio.
Perfect.
Nice.
Perfect. So and now, was this what you were holding previously? Because that's a 27% down payment, right?
Not necessarily, right? Because certain loans before, what we were doing is up to 75% LTV,
Yep.
but up to 90% loan to purchase price.
Right. Okay.
Okay. So in that way, what was happening is, as long as you were going out there and you were finding deals with built-in equity,
right,
you could put down 10%.
Right.
You know, so it created this great relationship with our clients where, you know, they were out there sourcing deals that had plenty of equity for us on the front end. We were holding all the construction money, and they only had to put down 10%. You know, so it's just this great relationship. You
How
know,
much of the construction, were you funding 100% of the construction costs?
100% as a reimbursement schedule. So,
Okay.
you know, and man, you talk about contraction. You know, we were doing condo conversions, you know, 600,000 condo conversions with 400,000 construction budgets in Dorchester.
Yep.
Now that has contracted to a 70,000 max construction budget for now, you know,
Wow.
in the COVID
Is
environment.
that with draw schedules and that kind of thing, inspections and all that good stuff? Or how do you...
Yeah. And that's all been outsourced to third parties. Trinity's a great one. Land Gorilla. I don't know if you've ever heard those names, but they're just these third-party groups that they go out and inspect the property, take pictures.
Yeah.
You know, we add it to, in case we need to, like, if we have a loan on our balance sheet, it's good to have all that stuff because you can package it up and go, here's all the due diligence steps. You know.
Nice. Nice.
So, but in regards to what was the previous question? I apologize. I got off track there.
I can't remember now.
Oh.
It's okay.
So I was asking 100% construction. You were saying 90% on the lending side.
Oh, Galter, you were asking about the down payments.
Yeah.
27% down payment. Yeah, it was a 10% with the built-in equity, but now everything's 80%. That has contracted as well. It's 80% of as is or purchase price, whichever one's lower. So it's 20% minimum.
And what's your feeling about if you're lending that kind of money and the person sourcing the rest of the money from borrowing from somebody else? Is that a underwriting problem?
Yeah, funding.
Yeah, I just don't put it on the HUD. You know, I just don't want to see it.
It's like, really don't care. Just don't tell me.
Yeah. If you have somebody who wants to write you a personal note, okay, you know, as part of our underwriting standards, you know, these aren't government backed. This is private lending.
Sure.
So if you have somebody who wants to write you a personal note, fine. You know, if they want to secure it against the property, you know, we can't do that. So
they can be in second, or they can't do that at all.
No second mortgages. No.
No. Okay.
Yeah.
And what is
but people can lean against a car. You know, they can. You know, whatever they want to do.
Other property, yeah, they can.
Other property, yep. So what is the reason not to take a second mortgage? What if somebody was looking to do exactly what you're doing? What would be a reason not to take a second mortgage on a property with you?
Well, everything we look at is worst case, right? So, you know, if we're looking at a loan, we say, okay, you're going to take a second mortgage. The question becomes, what happens if the first mortgage is current, but they default on the second? You know, that second mortgagee is going to do the same thing as the first mortgagee. He's going to foreclose on the property to get his money back. And so that's going to create problems for us, even though we don't have any problem with the client. That's going to create problems for us that we will inevitably inherit.
Right.
You know, we'll inherit those problems, and now we have to deal with them. So
yep.
If everybody's getting paid, there's no problems. But, you know, you can't write business off of the perspective that everything's going to go right.
Right.
Yeah.
Exactly.
You know, you got to write business off the perspective that everything's going to go wrong.
You plan for the worst, you hope for the best in business. It's, you know, we have all the contingencies.
Yeah, sure.
Love that.
Hey, I actually have a couple questions for you real quick. Can you talk to me a little bit about your path from 0 to, you know, 50 units, and maybe just the back of the business card? Cause I know it's, you know, you talk about that a lot.
Sure. Sure. And you know what? Mike loves this one anyway. So he's got the goal for 50 units. So first one, I think everybody starts with an FHA loan. I did like anybody else, start with a single family. Then 4 years later, as a move and flip, turned it, walked away with 34,000, bought 2 properties, a 3 and a 2. And took a year off thanks to getting divorced. I thought that was a good thing to do. And then bought another.
Your own divorce?
Do you file your own divorce, or do you hire a professional?
Yeah, no. She hired a professional. I helped pay.
Oh,
Broke to $250,000. You know what? It's a good thing that she did, because in the end, I think she made an extra $2,500 or something like that. So she did get a little extra, which you know what? She knew that everything got done right, so that was important to her. And God bless her. So at the end of right, teach her hard, right? But at the end, I took that year off, but I was hunting the entire time, building new relationships, talking to private money, hard money. And I finally talked to an attorney, and he said, I'll lend to you. Why don't you just do the deal? Let's do the deal together. There's plenty of upside here. And I until that point, I'd never taken on a partner. But I was like, okay, you know what? Let's do it. I bought it, flipped it, made 32 for me and 29 for him, and still had money to pay back another partner who actually bought the property. I just bought the contract from, so I paid her 10. And that was kind of the beginning of partnerships and seeing flips. I never believed in flips. I always liked buy and hold rentals. But that was in the back of my head now that this was possible. I took that money, took that cash, and I rolled it into buying 2 more properties. A single family that was subject to existing mortgage, so I only put $2,000 on that. And then I bought a 3 family for $115,000, and I went hard money on that. Went 20% down on that, and actually I put 30% down on that because my lender was a very cautious person. And it was 14% interest, 2 points, 30%. So he really made sure that I was a safe buyer. He told me I never want to own in Fall River, and so let me just make sure that if I ever did, it's a good situation. Right. So I ended up flipping that a year later for $150,000 profit. So I sold it for $250,000. I only put about $25,000 into it, and that capital started rolling the bigger machine that let me move into a 4 family, a 4 family, another 3 family. And then I ended up selling 2 more of those and partnering with Ron. Ron was sitting on $200,000. I was sitting on absolutely nothing. I had nothing in the bank because all of it was sitting in all these properties. And he was able to allow us to really expand. And in fact, it was interesting. A lot of our first properties we bought together, we didn't actually use money. We used the leverage of my relationships, the leverage of my experience, and the fact that I had already owned, I think, about 22 units at the time. And then I started selling my units off and buying with Ron. We bought we bought 6 properties within 3 months. It was a 10 unit, a 5 unit. It was another 6 unit and 2 3s. And within this short period of time, it was just like, wow, we bought all these properties. And one of those 6 units actually had a single family, a commercial space, and a 4 family. So it was really 3 lots. And we just immediately chopped the single family off and sold it. Right. And that started getting us this momentum. And we got up to 42 units, sold down between he and I, we sold down to 14 units plus the 3 family I'm in, right? So 17 units. And then we went and bought a portfolio because now we'd raised a lot of capital. We raised a lot of relationships. We went and bought a portfolio of 24 condos in one shot for $860,000. And we put almost none of our money into that. That was private money.
40 a door, something like that. Yeah.
That was about $35,000 a door.
35 a door. Yeah. Yep. Wow.
We just sold one of those condos. We bought those in October. We just sold one of those condos for $106,000. And
yikes. Wow.
With no renovation. We literally just moved the tenant out and painted the walls. And so
wow.
And then in January, we picked up another 11 units. So we're back up to, and I had a 4 family, so we're back up to 57 units, and we just sold down to 49. And we're at a comfortable state where any condo we sell buys us a 6 family. We just 1031 exchange, and we keep rolling it. Sure. So it took us 2 years as a partnership, right? But prior to that, I'd already had 3 years of just kind of learning the business, building a little bit of an experience portfolio. And I think that you could do it in 2 years. I really do. I think you could do exactly what I did in 2 years, as long as you were aggressive enough in year 1 and intelligent enough in year 2, right? Because you muscle your way through in the beginning. Just, buy something, buy something. But year 2, it's all about relationships. It's really who has the ability to go and find me a deal. I paid wholesalers, right? I paid them fees.
Walter, do you think, I love it when you say you can do it in 2 years.
Aggressive. You have to be extremely aggressive.
But my question is, does the fact that the market is frothy or up there, does that change that number? It just seems like deals are harder, or is that just a delusion that I have?
So I love that. That again, Mike, is a bad mindset, right? So grab your bracelet. If you got the Optimus bracelet, right? Slap that thing on. Give yourself a little slap.
At least I acknowledge that I see that that's just an attitude, you know. Brenda's constantly saying, you can find stuff in this market. Don't worry about it. So.
Yeah. So is it harder? Absolutely. Absolutely. But you just have to be a better marketer. And I have no problem paying other people. So I teach people how to market for property. And then when they find me a deal and I close on it, I just make sure that they padded it wholesaling. So the $600,000 portfolio we just bought, the 11 units, that was 2 3s and a 5. And they got it under agreement for $600,000. I bought it for $610,000. Okay. And so they made $10,000 for being in the middle of that contract the entire time. And that's something I have no problem teaching people to do that, because I didn't have to go hunt for that property. Right. All I did was go in and put the money in the deal. And actually, the seller brought 20% down. So I again put no money into this deal. The seller brought the 20%. My hard money lender.
I mean, you're saying exactly what Dave was saying at the beginning. That you let people do what they're good at, and it saves you time to do what you're good at, and everybody wins. Hey, so Dave, do you own any property yourself?
Actually, no. I've been focused on paper, for the last 10 years.
Which is fine, because whenever I hear anybody talk about this, they all want to get to where you are.
Yeah.
Even Walter says when he gets to 5 million at 12%, right?
Yep.
You're done, except for the
12 million at 12% would be okay.
Yeah.
So I've been in Rhode Island since 2011, and I've sold 3 buildings on the east side, just on my own balance sheet, like just things that I found, lived in, or thought it was a good deal. But it just seemed like a seller like that. It just seemed like a seller's market.
Totally.
Last year, and so we marketed we had a 2-family property. It was an illegal 3. My wife and I converted the top 2 floors into a townhome.
Nice.
Used the depreciation, the whole thing, the whole cycle, and great property. Great property. Yep. Marketed it at a good number. Sold it in November. Converted everything to cash. Put it back on the street. Lent it right back out. And additionally, in January, I just got to tell you guys this, because this is like unbelievable. But I read an article, and not to get in the weeds about like how stocks are valued, but basically stocks are valued off of like their net earnings, like whatever, like, you made $100, but it cost you 90 to make that 100. So you got $10, and then there's some multiple. You say like, okay, so we don't think you're going to go out of business. So, we'll give you 5 times $10, $50 a stock, whatever. Right. So I read an article that there was 100 really prominent companies that were trading off of a multiple of sales as opposed to net earnings.
No way.
So I read that article in January, and I was thinking to myself, think about the multiplying effect of that. So they were basically calculating the multiple like before costs, before backing out the costs. That'd be like, just to put it in real estate terms, that'd be like calculating a cap rate before you back out all of your expenses. It doesn't make any sense. It's crazy.
Yeah. It's not NOI. It's gross revenue. We did okay.
Right.
Didn't make any sense. So after reading the article, I took everything that was correlated to the market. I took it out and put everything in bonds. And then, because I thought the market was going to reset. How could it not reset? Hello. It's like totally overbought. Yep. But then coronavirus hit, which of course nobody saw, but it was just lucky. So everything I have is either in cash or non-correlated to the market, mortgages or real estate. So,
awesome.
but
yeah, I
think it's a little prepared and a little lucky. on that one.
Yeah.
But,
Cool.
We did the same thing. We've been calling a crash. I mean, me and my business partner have been calling a crash since 2015, right? So every year we're calling the crash. We're saying, yep, this year's the crash. This year's the crash. So we've always invested that way, saying, tomorrow could be the crash. Let's just make sure that we pull a position that makes us feel confident. And we sold a lot of real estate in January and February. And we sold some real estate we were aiming to sell in December, but it ended up closing in January and February. And so we're in a good cash position right now, and we're continuing to look for deals because we're in that position to do so. But what I wanted to get to, and you were just talking about being all in paper and in cash, and that is a strong position today. But a year from now, it's a weak position because real estate is going to continue appreciating because of the quantitative easing that government just put into everybody's pockets. So the dollar just went down in value, even though we don't see it or feel it yet. It's coming around where everybody's dollar is about to go get spent and everything else is going to go up in price because the supply and demand has shifted. And so gold and real estate are the right assets to be holding. The problem with gold is you can't leverage it. So 10,000 in gold gets you, if it doubles, gets you 20,000. 10,000 in real estate at a 10% down payment doubles, gets you 10,000, gets you the additional 40,000 on top of your return. So it's this leveraged asset that makes sense to be holding right now, leveraged, right? Not in cash, holding that asset leveraged. This way you can buy more of it and have more out there growing value. So our previous model was sell these condos. We bought condos just to flip them. And it was 24 flips. We'll do it over 2 years, no big deal. And now, although we see the appreciation, we were looking to take a lot of that cash and just use that as income and 1031. Now, and our model was buy 6 families. Now we've shifted our model to buy 3 families because they appreciate better. And we want to spread out a little bit more of that appreciation play. And they hold themselves, right? 3 family, we never had an issue paying out a 3 family, right? As long as you fill all the tenants up, you're getting $3,000 a month. In the way we buy, you can never buy it and not do well, right? So the 3 families are the lowest we'll go. We won't touch a 2, but a 3, 4, 5, 6, the 5s and 6s don't appreciate the way a 3 does. And we're in a high appreciation market. We want to be holding those. Mike, yeah, you got a question?
Funny, we got 3 people. We got 3 people here, and we all took different strategies, but we all ended up in a great position. Because my position is I stayed in stocks. My dad's been investing in stocks for like 55, 60 years now almost. And so I didn't sell anything unless I was just reapportioning. But what I did do was I reduced my leverage on my stocks with my margin that I was doing. And now I'm in such a good position that if something comes up, I've got the money to go buy. I just think it's funny that everybody has a different strategy, but they all seem to be working pretty well. And mine, Dave, is I think it's just lucky. I said, you know what? Let's just pull back a little bit here, And then COVID hit. That was just craziness.
Yeah.
So.
Yeah, no, it's not
COVID. No, there was just an intensity in the market, right? There was this intensity in the market coming into winter that we had to have all felt. Yeah, there was just something there. And yeah, COVID having an effect sped it up, but the fundamentals behind all of it was sitting back there ready to reset anyway. And being intelligent, making those moves, end of the year, fiscal preparedness, taxes are coming up. We're all making these moves and shifting assets around. I did the same. I reduced my margin. Actually, but I reduced my margin a little slower. So I had a margin call on one of my products. But yeah, whatever. So I went back and doubled down on that same exact
double
stock.
Mortgage back.
Yes, that's the one. I had a double. Yep.
No, I'm not criticizing you. I was just saying I didn't understand it. I was like, this is, Warren Buffett says,
that's what they had.
You don't understand. Walter's talking to me, and I'm like, I don't even understand this. My head's about to explode.
So think about this. So they were double-backed mortgage rate. I was doubling down margin on them as well. So they were using all their margin. I was using margin on them. It was just it was a house of cards. It was guaranteed to fail at some point.
Yeah.
but it was also the sign of, it was the first one to get hit out of all my stocks. So as soon as that got hit, I pulled margin back on everything else. And painful lesson, but at the end of the day, it made me so much more in the years I held it, that it was a loss leader. At the end of the day, it was the canary in the cave, right? As soon as that thing went, I said, "Oh fuck!" Like pull margin back. So yeah, everybody learns, and
you could do a whole podcast on the. You could do a whole podcast on the double-edged sword of margin. The multiplying effect both ways.
Yeah.
Right.
But
right. Yeah,
multiplying effect goes on both sides of the scale.
I read like 3 different books recently that said never use margin. But meanwhile, my father has been using margin to grow his portfolio for forever, and and he's been very successful at it. You're right.
Sure.
Yeah.
Just gotta know your risks.
So Dave, know your risks. Margin's like leveraging. It's like a mortgage, except they only let you go 2 times, whereas with a mortgage, you can go really, really far with an asset that you pretty much can manage and force appreciation in. And that's been our model. And Dave, you asked how we did it. It's because we bought with a 20% discount on everything that we bought, minimum 20% discount. And we always bought value add. So we add another 20%, sometimes 30% to the property through very, very little cost. And in the end, we're sitting on 40 to 60% equity positions on everything that we bought, even though we bought it 6 months ago, or in some cases 3 months ago.
Great job.
Because
that's
of how
awesome.
we bought it. Yeah, right? I tell everybody I made $1 million last year. It's just I never cashed the check, right? It's all sitting in the equity right now. At one point, we made 1.6 million on that purchase, right?
Hey, Dave, you're lending other people's money. So who are these other people? Because they're not, like you said, your lawyer had a whole list of mom and pops that were lending money. So who do you get your money? Are they like institutions? What's the?
Yeah. Through my partner, we had what's legally referred to as friends and family connections with different groups. But just on a little bigger, folks who are, running, funds who invested in this type of product. So that's what we started with. And then, basically it's just it's a waterfall, right? So, a 12% loan comes in, we get a equity piece, equity piece of that payment, our partners get an equity piece of that payment, and the people they're managing money for get a piece of that payment. So it's just a waterfall. And we still have those relationships, but post-COVID, all of that kind of froze. So we've had to go out and kind of develop other relationships with other people. So it's actually in flux right now, but, with a track record, you can go out and market yourself, to anybody you like. So having a portfolio of loans, having a successful track record, showing people that you can manage a portfolio of deals is the golden ticket. You can go out and raise as much money as you like. So that's what we're doing now. We're just in the process of, we have groups that we're set up with who, candidly, we don't love the terms, but, you have to survive. When you're in survival mode, you just you have to, find unlikely partners to, work with until you can negotiate to a better position. So we have relationships right now, but we're certainly would love for our old relationships to come back on board, and then also find new ones, so.
Yeah. Do you see that? Do you see them coming back? Your main lenders coming back? Have they told you?
Oh yeah. I've seen the whole market, the knee-jerk reaction when the whole thing hit was either a complete freeze or everybody just went to 60%, no construction. So everybody just dropped to 60%, 40% down, or good luck, So, but even from there, we've gone from 60% to now it's 80% with 100% construction, capped at 100, at $70,000. So you could see it kind of coming back. Before long, it'll be okay, 80% unlimited construction, and then back to 90 unlimited construction. So it's just kind of coming back, but everybody's just worried about the trap door. I think there's this mentality where people think like, the market's up, but it's not, for instance, Pier 1 just filed for bankruptcy. I just read that today. So everybody's going, the market's only down like 6 to 7% from where the highs, like, but retailers are going bankrupt. Like, where's the trap door? Are we going to go back to 50% down? So until that kind of, that's itself out, I don't think private equity or the non-qualified mortgage, which is the space we work in, the non-qualified, things that aren't government backed, I don't think it'll come back 100%. That's my opinion. So.
Right. And I think you're right, Dave. And here's some of the fundamentals behind it. We've known for a long time that retail was a dying ship. We knew it was going. We've stayed away from any kind of retail, commercial buildings. We've stayed in our lane with multifamily because we see people still needing a place to live. And we do think that at some point when retail gets cheap enough, the properties get cheap enough, that multifamily investors will flood the market again. We see that the retail guys are going to shift over to multifamily. They're going to spend the money. They're going to build up more multifamily. We'll see inventory increase on the market for multifamilies. And we'll see a shift of people going towards renting as opposed to owning, because we genuinely believe this big quantitative easing they just put into the system is more than they've ever done. And we're going to see inflation on a level that we haven't seen before. And I don't know that they can put an instrument in place to stop that. And we're in a generation of people who don't like to buy houses anyway. Millennials would rather rent. They'd rather bounce around. They're walking around with high student loans. And so the whole lending arena, when you look at the asset class, right, with COVID, we can't evict tenants, technically. We have other ways of handling our tenants and making sure those issues are solved, because guess who else isn't open? The city. So there's landlords, taking things into their own hands and doing things a little differently than would have in the past. But at the end of the day, we really just want to make sure that our money is protected. When we're investing, we're putting it with a private money lender, and the product is being worked through and processed. I think that real estate is going to continue going up in price. I told my business partner, we're looking at it like, how could it go down? Like we've always been the guys saying, look, it's got to go. It's got to die. It's got to die. It's got to die. Like, look at all the signs. It's got to go down. The only thing that could take it down now would be federal, some sort of government decision, some sort of government instrument, because all the other economic levers are pushed to push real estate up. Interest rates dropped, quantitative easing, all the money has to go into something, right? Everybody who's got money is now looking for the one asset that protects it, gold or real estate, because they know that in a high inflation market. So now we're looking at it saying like, well, what assets will go up the most? Retail won't be the one. Office space likely won't be the one. Industrial has been a dying breed unless they come up with something else we can produce cheaper than China. Multifamily is the one to start putting your assets into. And as everybody else notices that, what does that do? It drives up the cost of real estate. And drives up the cost of rents, because now you're buying with a bigger mortgage. You got to get more money out of your property. And so we're gonna see this flux on the multifamily side. I'm sure we'll overdo it. Everybody's gonna go, it's too hard in that market, overdo it, and we'll see a correction on multifamily. But right now, it's really, I wouldn't want to be in anything else. I've always said like, maybe we should slow down a little bit. But in this case right now, I'm like, dude, I want to buy as much multifamily as I possibly can. While everybody else is scared, while everybody else is frozen, while the market's not taking it, this is the chance to go big. I don't think we're going to see a crash on our side yet, and that frustrates me. Frustrates me so much.
I know a private lender, Walter, if you need someone.
Do you?
A private lender, yeah.
Yeah.
So Dave, all of that said, I'm sorry guys, I went on a rant there.
Hang on one second. So what do you call yourself? Do you call yourself a private lender or a hard money lender, or is there a different term that you use for what you do?
Whatever you do, just call us.
Okay.
Just call us. I love
Whatever
it.
name you decide, just dial the number. Just call us.
Okay. That's fair.
And
5
Dave,
point
good
lending.
good point. Mike, thanks for bringing that up. Dave, what is your contact? What is the
Yeah.
easiest way for somebody to get in touch with you and your company to find out what your lending rules are? Because it's going to change as this comes out. What's the easiest way to get in touch with you guys?
Yeah, foxpointlending.com. We're actually located in Fox Point, right here in Providence. We're a local presence. We're not going anywhere. And just check out foxpointlending.com. If you have any questions, just email them to info@foxpointlending. And it'll get to the right people. We'll get the answers.
I have to take exception with you saying you're in Fox Point. I grew up on the east side of Providence. You're in Richmond Square. That's like right down there. It's not Fox Point.
Are you sure? We got to look at the line. We got to look at the neighborhood lines.
That's fair.
I love that. I love that. So it's Rhode Island is a very small little state, and I've discovered that everybody sees it differently while I'm in there. Cranston to Warwick, they're like, nah, don't go to Cranston, right? And Warwick's like, forget Warwick. And Providence, even east side of Providence. Oh, it's on the east side of Providence.
Well, you said,
Providence.
I've said this to Dave like 3 times. He's probably like, oh my God, but he's actually in the building that my dad developed. He's in Richmond Square, so that's a small world, isn't it? So there we go.
I love it. Yeah, I love the tie-in. I describe Rhode Island as regional.
Yeah.
We've got our own little regions, and we're like proud of it. Like here's where I'm from, here's where I live. So it's a regional place. Yeah, East Side. Yeah.
Rhode Island's one of my favorite places to hang out. Unfortunately, during COVID, the governor was like, well, no, we don't like Massachusetts for a little while. But it seems like she's releasing some of those restrictions. I'm scheduled to go out to one of the cigar bars, Tel Aviv, sometime this or next week. So they're opening it back up, outdoors only. So it's nice to see that the state is opening back up, letting their neighbors back in. So I'll be over there hanging out with you guys at some point soon.
Sweet.
Yeah. Well, hey, I had a question for you guys. Just because you guys are so involved in motivation and things like that, what's a book you're reading right now? Like, what's a book you would recommend to me, to the group?
Love that.
Well, this week's book is Ray Dalio's Principles, which Walter just got in Amazon.
I did. Oh, yeah, you know what?
Hey! In November, Ray Dalio said, "Cash is trash." I heard him say that in November.
100% right. Ray Dalio is on point with that. We're getting into real estate, right? We're going deeper into real estate. Last year, we were talking, dude, cash position, like we were on it. And now we're just like, fuck. Like, I love a cash position. It feels, cash in the bank feels amazing. There's nothing more better like feeling than knowing, oh, look at all the zeros. That's freaking awesome, right?
Yeah.
But right now, we talked about it. We're like, dude, we gotta move into real estate right now. We've got to get out of this cash position because cash is going down. Cash is trash.
Yeah.
And this guy understands.
Whoa! Ray Dalio said that. I didn't say that. Ray Dalio. I don't necessarily agree with that right now, but
borrowing quotes.
But Ray Dalio, he's a commodities trader. He understands currency. He understands money. He understands economics. All he does all day is what I spend as a hobby, right? Like he does for a job, economics. And I'm like, I'll go and study and I'm looking at things and I have a small understanding. When he says something, it's leveraged behind years of experience and systems.
Sure.
And he was one of the first people to have a computer go and trade for him, like building computer programs to have the stock market traded on a almost molecular level, right? On a scientific level. And so he understands it. Like if you're able to automate and say, yeah, go trade for me with a system in this market, that's a level of confidence of systems. And the name of the book is Principles. So that, if you're interested in understanding the economy a little better. Yeah. But I would say this one, I just finished reading Big Shifts Ahead. And this is talking a lot about economic shifts, where they're coming. It was written in 2015. It's all still relevant. I'd say it's relevant till about 2025. They forecast real estate and how things are going to go in the future. And that's a good one, man, especially for somebody who's putting people's money to work. You are 100% in the right business. You're in the right business, doing the right thing. Putting people's money to work in real estate is by far right now, I think the highest ethical moral duty that somebody can do. If you already have the skill set and the ability to do it and doing it right, morally and ethically, then it's the highest use of your time. You know, don't jump out of this because real estate's going to hold its value. My opinion, you know, completely speculative, but you know, read the books and see what they're saying. Then the other one is one of Mike Schein's favorites, Go Giver, which is all about
Oh yeah.
you know, going out and giving more value.
So Dave, we're actually doing 52 books in 52 weeks right now. So we're on like book 17 of 52 books. Walter, we gotta figure out a way to post those every week, or just have the list increase like on the website or something like that.
I'm gonna put it up on the blog. So I'll put it up on the blog, and then I'll put it in the event. Its actual event itself as part of the description, what the book is, so people can kind of buy the book and get prepared before the actual training comes out.
Yeah, they're not all as thick. They're not all as thick as Ray Dalio's book. You know? Yeah. Like Go Giver, you can finish in finish in 2 hours. Ray Dalio is like a month. You know.
Yeah, this is a 20-hour book. It's no joke.
Yeah.
What are you saying, Dave?
Can I give you guys a submission for consideration to the 2 weeks?
Absolutely.
Yeah, absolutely.
Bill Walsh, The Score Takes Care of Itself.
Bill Walsh. I like him. I've actually seen him live. Phenomenal speaker.
What is the name of the book?
Bill Walsh, The Score Takes Care of Itself. Former head coach of the 49ers. And this guy was an over-preparer and actually disregarded the idea of the score of the game or winning, and focused all his energy on procedures, systems, the way his guys dressed. You know, like he had very specific standards for how they tied their ties, right? Single Windsor versus double, like down to the the way that his guys would even knot their ties. So Bill Walsh, The Score Takes Care of Itself. I submit that for consideration.
Yeah, absolutely.
Excellent book. Just to switch your mindset from, how do I win a game to forget about the score. That'll take care of itself. How do I focus on preparedness? Good book.
How do you prepare yourself to play the game?
So Walter and I sat the other day and picked out the 52 books for the 52-week Principles of Wealth, which Walter does on Saturday mornings. And so we're going to have to add that one as like 53. And I have a submission for 54 because we neglected Shoe Dog, which
Shoe Dog's a great book.
I just started it. I just started Shoe Dog.
Oh, nice.
Yeah.
You're gonna love
it. I think I was in the shower thinking about the list, and I was like, "Oh my God, this isn't on our list." That's So.
Yeah.
We'll be reading 104 books.
Bill Bowerman, Steve Prefontaine. That story is incredible. I don't know if you've ever read the whole thing, but before I even started Shoe Dog, I've been I think every kid in college when he starts running, starts looking up Steve Prefontaine and he's your running hero, this like outlaw hippie rebel. But Bill Bowerman's another guy who, man, you talk about a guy who's focused on systems. He cutting out ounces, right? He said, he broke it down and said, if my runners could cut out 1 ounce every step, and then did the math and said, that's 50 pounds per race, that's going to give them a competitive edge. Bill Bowerman is just like the king of that. And then him and Phil Knight formed an empire off of that. But awesome.
That's so awesome. We're going to have you on again and talk more books next time.
Yeah, Dave, I didn't know. I didn't know you were into the personal development like this. So definitely conversation, man. Thank you for adding so much value. Give us a real insight to your industry and having a second opinion on a lot of the stuff that we're talking about here. So, I mean, it's all about building wealth and building our 100 millionaires. And talking to other millionaires really helps us build that system. And what can we give to help everybody else rise up? And how, in giving them an opportunity to partner with us. Dave, what are you looking for? Mike, what are you looking for? I'm looking for more property. Like having those conversations, giving people an opportunity for us to go and pay them, right? To give us opportunities to partner with each other and do more business. So Dave, we appreciate you for jumping on with us, man.
I'll say just quickly, I know we're finishing up, but
Yep.
when I mentioned 100 millionaires, I just want to say that Dave was really excited about the concept, and I just thought that just shows the quality of the type of guy Dave is. That's awesome. So yeah.
Absolutely, yeah. High tides raise all ships. You know, let's all work together.
Yeah, appreciate you, Dave. Thank you for being on. Mike, what is your sign off? What do you always say?
Passive income from passive income. Woo!
You heard it here, guys. When you have a choice, always work with the best. I'll see you guys in the next one.
Okay. Bye, Dave. Thank you. All right. So.